Have you ever wondered how a handful of families came to control the financial pulse of the world? Long before Wall Street, before digital currencies, before central banks became the ultimate authority, the global economy was shaped not by governments, but by dynasties. These families didn't just lend money, they built empires from interest, influence, and insider access. But where did they go? And why do their fingerprints still appear on modern financial systems centuries later? If you're watching this right now, take a second to let me know in the comments which country you are re-watching from and what time it is there. It's always fascinating to see how far these stories reach across time zones. And if you enjoy uncovering the hidden history behind the money in your wallet, consider subscribing. You'll never see economics the same way again. To understand today's global financial order, you need to understand how it all began. Let's start in medieval Europe. In a world where kings fought endless wars and governments constantly ran out of gold, someone needed to fill the gap between ambition and reality. That someone wasn't a nation, it was the banker. The earliest banking families, like the Medicis of Florence, did more than count coins. They invented double-entry bookkeeping, funded papal campaigns, and even placed their sons in positions of power within the Catholic Church. And they blurred the line between money and religion, between commerce and politics. When the Medici Bank collapsed in the late 1400s, it wasn't just a financial loss, it was a political earthquake. But what came next would change the world. As Europe entered the age of exploration, new families rose from the ashes of old ones. The Fuggers of Augsburg became the financiers of emperors. Jakob Fugger, often called Jakob the Rich, lent so much money to the Habsburgs that he effectively bought them the crown of the Holy Roman Empire. In exchange, he received monopolies on copper, silver, and mining rights. His wealth rivaled that of kings, and his strategy set the standard for how banking families would operate for centuries. Control resources, fund governments, and ensure they owed you more than you owed them. But no family mastered this system like the Rothschilds. From a humble coin dealer's shop in Frankfurt, Meyer Amschel Rothschild built a network of 5 sons, each stationed in a different European capital: London, Paris, Vienna, Naples, and Frankfurt. They created the first international financial web. In an age without telegraphs, without the internet, their family couriers could deliver financial intelligence faster than any government. During the Napoleonic Wars, that advantage became priceless. The Rothschilds financed armies, sold bonds, and used their communication network to anticipate shifts in the markets. The legend says that after the Battle of Waterloo, Nathan Rothschild knew the outcome before anyone else in London and used that information to dominate the bond market. Whether or not the story is true, the impact is undeniable. The Rothschilds proved that information, not gold, was the most valuable currency in finance. By the mid-19th century, they had become synonymous with wealth. They lent to governments, built railways, and underwrote empires. When countries like France and Britain wanted to go to war, they often needed Rothschild approval first. Their influence reached from Europe to the Middle East, shaping the global balance of power. But they weren't alone. Across the Atlantic, another set of families was quietly rising: the Morgans, Rockefellers, and Mellons. They built their fortunes during America's industrial age. Unlike their European counterparts, who lent to monarchs, these new banking families financed corporations. J.P. Morgan, in particular, didn't just lend money, he organized entire industries. He consolidated railroads, rescued the U.S. Treasury during the Panic of 1895, and even bailed out Wall Street in 1907 before the Federal Reserve existed. For a time, Morgan's word could move markets. He once said, "The first thing is character, before money or anything else." But character wasn't what made him powerful. Control did. By merging finance and industry, Morgan turned capital into command. Meanwhile, John D. Rockefeller built an oil monopoly so vast that the U.S. government eventually dismantled it. Yet the fortune didn't disappear. It diversified into banks, into philanthropy, into influence that outlived its original source. The Rockefellers funded universities, medical research, and global organizations. They became symbols of how money could be cleaned, reshaped, and repurposed into soft power. By the early 20th century, these families didn't just represent wealth, they represented stability. When crises hit, governments often turned to them for solutions. But as the 20th century progressed, something changed. Central banks began replacing individual bankers as the ultimate lenders of last resort. The Federal Reserve, founded in 1913, took control of the money supply that had once been in private hands. For families like the Rothschilds or Morgans, this meant adapting or fading. Some merged their banks into corporate entities. Others shifted to investment banking or asset management. Their names remained powerful, but their control was diluted. What had been personal dynasties became institutions. Yet traces of the old order remain. The descendants of these families still appear on corporate boards, in foundations, and in private investment firms. No, their influence isn't as direct as before, but it's embedded in the system. The modern global economy, the one tied together by debt, speculation, and credit, was designed by their predecessors. It raises an important question. Did these families lose power, or did they simply hand it over to a system they built for themselves? Because today, even though we think of central banks as neutral institutions, their origins are deeply tied to private interests. The Bank of England began as a private company lending money to the government. The Federal Reserve, though nominally public, operates through regional banks owned by private shareholders. So when we talk about the rise and fall of banking families, we're really talking about evolution. The names may have changed, but the mechanics haven't. Power and finance flows to those who can issue credit, control information, and survive crises. And those who mastered that formula centuries ago still cast long shadows over the global economy today. But what made these dynasties so resilient? And how did they use wars, recessions, and revolutions to protect their wealth when everyone else was losing theirs? Let's explore that next. When most people think of banking, they imagine vaults, tellers, or stock charts. But for centuries, banking families weren't just financiers. They were political actors. They shaped wars, dictated treaties, and often decided which countries would rise or fall. Their power came not from armies, but from credit. When a king needed funds to go to war, the banker decided whether that war could even happen. That single fact shifted the balance of power from monarchs to moneylenders. The Rothschilds mastered this game. By lending to both sides of conflicts, they ensured they'd profit no matter who won. During the 19th century, they financed the British in the Napoleonic Wars, the Austrians in their empire, and even the French in their Reconstruction. Each loan deepened their influence. They didn't need thrones because their bonds ruled the rulers. This system worked because governments were always desperate for funding. Wars cost more than taxes could raise. Infrastructure projects required more capital than any single treasury could produce. The solution was always debt. And who controlled the debt? The banking dynasties. Every new bond issue tightened their grip on global power, but their dominance wasn't unchallenged. By the late 1800s, America was emerging as an economic powerhouse. The New World wasn't built on royal bloodlines. It was built on oil, steel, and railroads. And those industries created their own financial empires. J.P. Morgan became the de facto central banker of the United States, long before the Federal Reserve existed. In 1907, when a market panic threatened to collapse the entire U.S. economy, Morgan gathered the country's top financiers in his library and forced them to coordinate bailouts. His leadership saved the system. The message was clear. One man with capital could do what governments couldn't. That power alarmed Washington. The idea that a private banker could control the fate of the nation led directly to the creation of the Federal Reserve in 1913. Officially, the Fed was meant to stabilize the system. Unofficially, it absorbed the functions once held by men like Morgan. It centralized monetary control under a hybrid structure, public in theory, private in practice. Yet the influence of old banking families didn't vanish. They adapted. The Rothschilds transitioned from government bonds to corporate finance. The Rockefellers diversified into global investments. New names joined the list: Warburg, Lazard, Kuhn-Loeb. These houses became the architects of early 20th century capitalism. They advised governments on reparations, reorganized industries, and built the first multinational financial firms. The world wars further expanded their reach. During World War I, banks in London and New York became indispensable to the Allied war effort. They floated massive bond issues, financed armament production, and managed foreign exchange operations. The war cemented the U.S. as the world's financial center, displacing London's centuries-old dominance. After 1918, the balance of global finance tilted west. The Great Depression then exposed the system's fragility. Over-leveraged banks collapsed, wiping out fortunes. But again, the elite survived. The Morgans and Rockefellers merged their interests into larger institutions. They understood the rule of crises. When markets panic, assets fall into the hands of those with liquidity. It wasn't luck, it was design. Every crash was a transfer of ownership from the desperate to the prepared. World War II reshaped everything once more. The financial elite positioned themselves for the post-war order. The Bretton Woods Agreement in 1944 established the dollar as the global reserve currency. Behind the scenes, Wall Street bankers advised on its architecture. It wasn't a coincidence that U.S. banks emerged from the war stronger than ever. Their European counterparts were shattered. Their American rivals were backed by the world's new superpower. By mid-century, the great banking families had evolved into financial conglomerates. The Rothschilds still managed private wealth, but their power was now institutional. The Morgans had split into investment and commercial arms. The Rockefellers used their foundation to shape global policy, funding think tanks and development programs that influenced international economics. They no longer needed to control governments directly. Their systems did it for them. But something changed in the 1970s. The link between money and gold, once the foundation of all banking, was broken. When President Nixon ended the gold standard in 1971, the world entered a new era of fiat currency. Money became pure confidence, created by decree and backed by nothing tangible. In this world, influence no longer required vaults of gold. It required control of credit and interest rates. Central banks, staffed by unelected technocrats, now determined the flow of global wealth. The descendants of old dynasties adjusted again. Many became private equity giants, hedge fund pioneers, and global investors. Their power was quieter, but broader. They no longer needed to finance kings. They financed nations through sovereign debt, corporations through leveraged buyouts, and governments through complex derivatives. The names on the doors had changed: BlackRock, Goldman Sachs, Carlyle, but the principles were ancient. Control credit and you control destiny. Still, some argue the families never truly lost influence. The Rothschilds' modern network spans private banking, energy, and advisory firms. The Rockefellers' descendants continue to manage vast endowments and foundations that shape global development priorities. These aren't conspiracies, they're continuity. Generational wealth, when structured properly, doesn't vanish, it transforms. If you look closely, patterns emerge. Each financial era produces new names, but the mechanisms repeat. A crisis destroys confidence. Those with access to liquidity buy distressed assets. New regulations arise, written by those who benefited most. Then, a new cycle begins. The rise and fall of banking dynasties is in T about luck. It S about mastery of that cycle. Even today, when governments announce stimulus packages or central banks lower interest rates, the beneficiaries are often the same. Cheap money flows into asset markets, not wages. The rich, who own the assets, grow richer. The structure is self-reinforcing. It was built that way by centuries of financial evolution. So when we talk about the fall of banking families, it's not a collapse in wealth. It's a diffusion of visibility. Their names might not appear on every headline, but their influence persists in the architecture of modern finance. The concept of hereditary control over money hasn't disappeared. It's gone corporate. And yet, every empire built on credit faces its reckoning. From Rome's debasement of silver to France's paper assignats, every system based on debt eventually reaches its limit. The same principle applies today. When money creation becomes untethered from production, the illusion begins to crack. In the 21st century, that illusion is wearing thin. Global debt is at record highs. Asset bubbles are inflating beyond fundamentals. Central banks are trapped between inflation and insolvency. The mechanisms built by centuries of banking families may have reached their breaking point. But history suggests something else. When one system collapses, another emerges, usually controlled by those who saw it coming. The next transformation of global finance may already be underway, and if the past is any guide, the same kinds of families, or their institutional heirs, will be waiting to shape whatever comes next. History has shown that whenever the financial world reaches a breaking point, it doesn't disappear. It reorganizes. Power rarely evaporates. It shifts hands, rebrands, and adapts to new tools. Today, those tools aren't gold or bonds. They're algorithms, digital currencies, and financial data. The empires of the past were built with vaults and ledgers. The empires of the future will be built with code and control over information. This shift is already visible. Look at how global finance now operates. The largest holders of wealth are no longer individual families, but institutional giants. Asset managers like BlackRock, Vanguard, and State Street. Together, they control tens of trillions of dollars, owning large stakes in nearly every major corporation on Earth. On paper, they are public companies with diversified shareholders, but in practice, their consolidated ownership gives them influence that rivals the banking dynasties of old. Yet their rise didn't happen by accident. When interest rates fell to zero and central banks printed trillions after 2008, the wealthy needed a place to park that money. Asset managers became the perfect vehicle. They pooled global capital, bought everything from real estate to equities, and quietly became the hidden kings of capitalism. They don't issue loans to governments like the Rothschilds once did. Instead, they own the companies that build and supply those governments. And behind this layer of modern institutions lies an old principle. Whoever controls capital allocation controls society, yes, direction. If you can decide which industries receive investment and which are starved of funds, you can shape the world's future. Renewable energy or fossil fuels, AI or manufacturing, pharmaceuticals or defense. These aren't purely market decisions. They're guided by concentrated financial power. But just like the 19th century, this concentration comes with fragility. Every bubble carries its own seeds of collapse. In 2008, it was housing and leverage. In 2020, it was stimulus-fueled asset inflation. The next shock could come from sovereign debt, derivatives, or digital assets. And when that happens, history tells us that those who understand the system's architecture will once again seize the advantage. Now consider the new frontier, digital money. Central bank digital currencies, CBDCs, are being tested in dozens of countries. On the surface, they promise efficiency, faster payments, and reduced corruption. But at their core, They represent the most centralized form of money ever created. Every transaction could be tracked, approved, or denied in real time. That's power no medieval banker could ever imagine. It's not about gold anymore. It's about data sovereignty. If traditional banking families controlled wealth through loans, modern central banks may soon control it through code. Programmable money could determine what you're allowed to buy, when, and where. And if history repeats, the private institutions that advise or design these systems will gain immense leverage. Think of them as the modern equivalents of the Rothschild advisors at Waterloo or the Morgans during the Panic of 1907. Only this time, the battlefield is digital. Meanwhile, private players are building their own alternatives. Bitcoin, Ethereum, and decentralized finance emerged as rebellions against centralized control. They promised transparency, autonomy, and a financial system beyond the reach of elites. But even in these digital revolutions, the old patterns resurface. Mining farms consolidate power. Exchanges act as gatekeepers. Venture capital firms buy influence early. Every system, no matter how decentralized it begins, gravitates toward hierarchy once enough value accumulates. That's the enduring truth of finance. Power follows the flow of money, and money follows trust. The old families built trust through gold and royal alliances. Modern firms build it through algorithms and regulation. But the core mechanism, controlling the levers of credit and confidence, never changes. So what does this mean for the future of global finance? If the last 500 years have been a story of consolidation, the next century might be one of convergence. The distinction between banks, governments, and tech companies is blurring. When a corporation can issue its own currency, or a central bank can analyze your spending in real time, the traditional lines of economic control dissolve. And in that fusion lies opportunity and danger. In moments like this, history becomes a mirror. The Medici financed art and empires, but fell when their debts outweighed their influence. The Rothschilds thrived by adapting across borders and regimes. The Rockefellers reinvented themselves through philanthropy and policy. The lesson is clear. Survival in finance isn't T about avoiding collapse. It's S about preparing for it. If another debt crisis erupts, and many economists believe it S inevitable, the next dominant class will be those who anticipate the reset. Whether that's through gold, data, or digital currencies, someone will own the bridge between the old and new systems. And those who own the bridge own the world. In the end, the story of banking dynasties isn't just about money. It's about how human civilization organizes trust, value, and power. Every generation believes it's different, that technology or progress has broken the cycle, yet the pattern endures, from Medici to Morgan, from Morgan to BlackRock, from BlackRock to whatever comes next. When you trace the lineage of wealth, it's not a straight line, it's a spiral. Each turn looks new but echoes the last. The symbols change, but the structure remains. The players evolve, but the rules, credit, confidence, and control, are eternal. And so, as we move deeper into a world where money exists only as numbers on screens, it's worth asking. Who really owns those numbers? Who writes the code? Who decides the rules of value in a system no longer bound by gold or geography?